Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Eric Crittenden, Chief Investment Officer of Standpoint Asset Management. Standpoint creates all-weather investment strategies, and we talk to Eric about his approach to blending different asset classes together, trend following, investing in environments like the 1970s where there was high inflation, and some of his original research on things like small cap stock performance and more. Developing investment strategies that investors can stick with regardless of the environment is something Eric has vast knowledge and experience in. As always, thank you for listening. We hope you enjoy this discussion with Standpoint's Eric Crittenden. Eric, hi, how are you? Thanks for joining us today.
I'm great. Thanks for having me.
We're going to talk about all-weather investing and some of the various investing strategies that you run as a firm and that you've developed. But before we do that, we were kind of talking just before we started the podcast about, getting some of these terms right when we're talking about these types of strategies. And our listeners and audience tend to be a little bit more individual retail investors, and there's financial advisors too. But we just want to start out with you by maybe outlining or discussing some basic terms that I think will be important as we go on in the conversation. So I'm going to put out 4 of these, and if you just want to kind of work through them, that would be great. So the first is trend following. The second is managed futures. The third is CTAs. And the last one is all-weather investing or an all-weather portfolio. So I know that's kind of a lot in the first question, but I thought it would be good to try to define those things.
Sure. Yeah. Thanks, Justin. I think it is important that we all be using the same glossary. So, I've been in the business for 24 years, and I've talked to a lot of people that purport to run trend following programs and people that say they invest in trend following programs. And the reality is, if you ask 10 different people, you're going to get 10 different answers as to what trend following is. So a high level overview is that trend following is a philosophy and a process of participating in trends, hopefully profitably. The idea is to identify trends at some point in their life before the end of the trend and participate. Generally speaking, in our industry, and we'll talk about CTA here in a minute, trend following is symmetrical, meaning you'll go long or you'll go short. You're indifferent to market direction. That's kind of the plain vanilla definition of what trend following is. It's attempting to capture directional moves, either up or down. My philosophy on it is a little different than my peers. I view trend following as a means of avoiding being on the wrong side of big trends. I see capital preservation and not being on the wrong side of large magnitude or long duration trends as being very valuable to your compounded return. I see that as more important than capturing returns, or at least mathematically speaking, it contributes more to your compounded return. So, but like I mentioned a minute ago, it means different things to different people, but on a high level, it's just being on the right side of the big moves, the sustained moves, and doing whatever's necessary to make that happen. The other phrase you brought up was managed futures. So managed futures is another phrase that means different things to different people. But broadly speaking, people that implement trend following strategies, people that trade things like futures contracts and forwards contracts are considered to be part of the managed futures industry. And a lot of financial advisors and retail investors aren't overly familiar with this industry because it's primarily been the stomping grounds of institutions and pension funds and endowments and accredited investors. And that's unfortunate, but that's the way it's been in the past. But over the past 15 years or so, those barriers have started to come down, and you've seen kind of a blending or a merging of managed futures coming over into the securities industry and being offered in things like ETFs, mutual funds, smaller managed accounts, so on and so forth. But managed futures essentially is referring to that industry where you have CTAs, you have portfolio managers that manage portfolios of futures contracts and forward contracts. The other term, CTA, so that stands for Commodity Trading Advisor. And so that would be the firm that manages a portfolio of futures contracts on behalf of clients. So there's also CPO, which stands for Commodity Pool Operator, and that's what we are at Standpoint. It's closely related to a CTA. So, if you buy a mutual fund that has stocks in it, it's going to have the advisor, it's going to have the portfolio manager. If they're using a lot of futures or a lot of forward contracts or whatnot, it's probably going to be run by a CTA or a CPO that's regulated inside of the managed futures industry. In our case, we're regulated by both. We're regulated by the SEC on the security side, but also the NFA and the CFTC on the futures side. So I don't know if that definition actually helped or if it hurt, but it is what it is. What was the last phrase? All weather?
All-weather portfolio or all-weather investing.
Okay, so this is another one where it depends on who you ask. So I'm going to give you my definition of an all-weather portfolio. It's kind of like, I like to use metaphors and analogies at times, so I'm gonna use a auto metaphor this time. So you guys might not be old enough to remember a time when there were no SUVs on the road. So in the 1980s, there was no such thing as an SUV. I think the Ford Bronco was the first, considered to be an SUV, or at least they weren't popular, right? So, you either bought a sports car, a luxury sedan, a motorcycle, or a four-wheel drive, or something like that, specialized vehicles that were great. A Corvette's great on an open highway at 5 a.m. with no traffic. A 4x4 is great if you have to cross a stream or go on a rough off-road fishing trip or whatnot. The dreaded station wagon was great if you had, 6 kids and all their soccer equipment and whatnot. But at some point, some really smart person figured out that an SUV could serve 90% of all those purposes. It could be luxurious enough for a night out on the town. It could be durable enough to go off-road to some degree. It can even be pretty sporty, not quite a Corvette, but sporty enough to make it worthwhile for you. So I look at that as an all-terrain vehicle. Drive it on the freeway, night out on the town, drive it off-road. An all-weather portfolio is basically the SUV of portfolios. It's optimally, you'd want your all-weather portfolio to work almost equally as well in all market environments. So inflation shouldn't be a terrible problem for an all-weather portfolio. Deflation shouldn't be a terrible problem. Runaway growth shouldn't be a terrible problem. An all-weather portfolio should be designed to work reasonably well in all market environments. Now, you don't get something for nothing. It's not alchemy. It will underperform whatever is most closely calibrated to that market environment. That SUV is not going to keep up with the Corvette, and it's not going to be as effective as the four-wheel drive pickup truck off-road, but it's good enough to do reasonably well in all market environments. And that's really important to investors because it solves two problems. One, it allows people to stay invested and not make emotional decisions when they have the wrong asset for the current market environment. And two, the way compounding works is it actually rewards this kind of splitting the middle behavior. Because by having an all-weather portfolio that's got uncorrelated assets in there, working together as a team mitigates the volatility and the risk in the portfolio, but it doesn't necessarily dilute the returns between the different asset classes. So you can maintain your compounded return over a long period of time, but really reduce the risk. So that's the motivation behind putting together an all-weather portfolio, and I hope that makes sense.
Yeah, I love that. That's great. I love that analogy, and I think that's a good way to sort of define all those things. So thank you.
I wanted to ask you, one of the challenges I would think in building an all-weather portfolio is there's so many assets out there you can invest in. And just looking, I know you guys have a broad-based group of assets you invest in. I'm wondering how you think about that decision in terms of which assets belong, which assets add value to an all-weather portfolio, and which ones don't. How you think about sort of which assets comprise your portfolio.
There's several different ways I can go about answering that question, and I could probably talk for 2 weeks. So I'm going to focus on the two most important concepts, and a little bit is my philosophy is going to bleed into that, because my philosophy and my team's philosophy guides our decisions. So the first thing I'll say is that I believe there are structural risk premia available in the markets, and if you want to collect those and have them show up in your account in the form of returns, then you have to provide some sort of a valuable service to the marketplace. You have to be accretive to the ecosystem that you're entering. I do not subscribe to the gladiator mindset of alpha and you got to get in there and be faster and stronger and smarter than everyone else. I think that's an idealized state of mind that is more, movies and books. But in real life, if you can offer a valuable service to the marketplace, it will welcome you and you will find your niche. You'll own that piece of real estate in the ecosystem and you'll collect your returns. So if we look at things like stocks, bonds, metals, grains, energy, livestock, these are all markets and they were designed for different reasons. But if they persist, there's going to be some sort of a structural risk premium there that you can collect if your behavior allows you to collect it. In other words, if you participate in the market in a way that actually adds value to the other market participants, you can collect that risk premium. So that's my philosophy going into it. It's not that I'm trying to be faster, smarter, or better than everyone else. I'm trying to earn that return by providing liquidity to whoever on the other side of the trade isn't profit seeking, or they're willing to suffer some sort of an opportunity cost because it's worth it to them. So it doesn't seem related right now, but I think it'll tie back to what I'm about to say next. So your question was about, how do we, there's so many markets to choose from. How do we pick which ones? Well, the first thing I look at is liquidity. Because if you think about what I just said, if you're going to provide a service to someone on the other side of the trade and you want to extract profits and you want to manage a few $1 billion, you need liquidity, because liquidity is the evidence that there is demand for some sort of a risk transfer and that there's some sort of a risk premia there. So how you measure liquidity is different for different markets. In stocks, it could be free float, it could be full float, it could be volume or some other metric that you come up with. In futures, it could be open interest, it could be volume, it could be open interest multiplied by the notional value of the contract. You've got to come up with some sort of a mechanism for determining, what is the proxy for the underlying risk premia and the hedging pressure and the kind of stuff that I look for in a market. So for me in futures, simply put, that's pretty much just the open interest. And on the stock side, it's the free float market cap. So I scan all the different tradable assets in the world that we're legally allowed to access from the US. And I do this twice a year. And then I compile that data into a database, and then I run some calculations on it, and I sort them from most liquid to least liquid, and then I go down the list, and there's a cutoff point at some point. Right now, it's the 75 most liquid futures markets in the world, and that's on the future side. And then on the equity side, it's essentially the MSCI World Index, which is market cap weighted developed nations, and that happens to be my current opportunity set. We'll probably expand that in the future as we get bigger, but right now I feel like that's completely suitable for our needs. Does that answer your question?
Yes, absolutely. Okay. I was wondering, one of the things that we've all been spoiled as investors because, if you look at the period from 1980 to now, we've basically had rates falling the entire time. We've had very little inflation. And so most investors build these stock and bond portfolios and come to rely on them. I'm wondering if you could just talk a little bit about what the weakness with that is and, what has happened in history where maybe that portfolio is not the optimal portfolio.
Yeah, Jack, that's a dangerous topic. I get the feeling you guys are going to ask me some tough questions.
Trying to get the controversial stuff in here.
Yeah. It's a topic that advisors don't like to talk about. And so candidly, yes, we've been spoiled. From 1982 until now has probably been one of the greatest, multi-decade stretches in the history of humanity. A lot of people don't feel like they've made a lot of money, but you've made a lot of money and you've made it easily by being long, convenient risk assets. Stocks have gone up, multiples have gone up, economic conditions, for as much as we complain about right now, it can get an order of magnitude worse than anything we've seen since 1980. And then, when I was a kid, interest rates were 18%, in the late 70s. Now they're almost zero. So you started off with a really high nominal interest rate and you finished with a really low nominal interest rate. So you got to collect all those high interest rates and you got the capital gains from the bond prices going up as the interest rates went down. So you got the double sort, the dual momentum from that. And that's why you have a 7 or 8% annualized return from owning the 10-year U.S. Treasury during that period of time. That's an astronomical number because that's essentially a risk-free asset in nominal terms, at least. So, people have been spoiled and they're kind of extrapolating that out into the future, and they just expect 10 from stocks and 5 to 6, maybe 7 from bonds. And they think a 60-40 portfolio of that is going to give them that in the future. What they don't realize is these markets are not utilities. They were not designed to make retirement easy. They weren't designed to be ATM machines or utilities. They're designed for capital formation or risk transfer. And the mechanism underneath the hood is to clear the market. And we've kind of co-opted them and said, well, let's just make these things work for investors. You can't rely on that forever. So to your point, does the 60-40 portfolio have a weakness? It does. It has a blind spot, and no one's seen this blind spot since the 1970s. And I would characterize it as it has a serious weakness if you ever get a period of stagflation. So if you get rising rates, bond prices will go down. If rates are below the rate of inflation, like we see right now, your real return will almost certainly be negative. And if stocks don't go up when bonds go down, if stocks and bonds go down together like they did several times during the 1970s, you're going to experience losses and volatility that you probably not prepared for. So it's one of those infrequent risks that people lose respect for. And they take things for granted because they haven't seen it during their investing career, their lifetime. But it is lurking, and it's a very real risk.
How do you think about bonds? It seems like if you're looking at bonds logically right now, you have very low yields. You don't have that much room to go down. It seems like, there's this popular narrative, which may very well be true. I have trouble discounting it myself, that bonds are just not a place you want to be right now. But then they do serve a purpose when you look at building an all-weather portfolio. So how do you look at that balance between, bonds don't look very attractive right now, but also they still have a purpose in my portfolio?
So I've tried to have that conversation with people, and that's an even more dangerous topic because what I've found is that more than 90% of people out there are absolutely married to their bond positions. So I've tried a couple of different ways to broach that topic. And the one that I found to be effective, you guys might probably think this is funny, is I would tell people, I want to get your opinion on a new product. And I'm just going to tell you what the product looks and feels like and the expected returns and whatnot. And you let me know if you think this is something I should pursue. And I say, it's got, and this was a year ago. And I said, the expected return is about 1% a year. And it's very sensitive to interest rates. Meaning if interest rates go up, this thing could easily lose 20, 30, maybe 40%. So it's very, very sensitive to interest rates. The only way this thing's going to, have more than a 5% return is if, the yield on the 10-year goes down to -5 or 6. And it's all ordinary income for the most part. It's all ordinary income. I'm describing the 10-year treasury to them without telling them it's the 10-year treasury. So when I go through all the attributes of it, people look at me cross-eyed and they're like, why are you telling me any of this? That's the worst investment I've ever heard of. Get out of my office. Why would I have any interest in ever investing in something with those attributes? And then I tell them it's the 10-year treasury and they get real mad. But the point has been made because they decided that was an atrocious investment that they could never make. In fact, I had a couple people say, I would expect a lawsuit if I did that. It's the 10-year treasury. So you tell me, why are you investing in it? And they don't have a good answer. So I like to invert things and do things backwards to see where people really stand. So I don't know. Is that a topic? I think you asked a specific question. That probably wasn't a specific answer, though.
I'm just wondering, how do you think about that when you're building an all-weather portfolio? Do you consider not having bonds if it gets too extreme? Do you underweight them? How do you think about that when you're building a portfolio?
It's tough, right? Because historically, bonds have been very, very productive and essential to most portfolios. But when I look at it now, the yields are below the rate of inflation. And when I look at the calculus of the macroeconomy, I look at it and say, well, if I'm the government, I'm going to monetize that debt, but through yield curve control and just have inflation outpace bonds. That's exactly what I'm going to try to do. I don't know if it'll work, but they're good. That's the plan, and everyone knows it. So, yeah, they're a terrible investment, as illustrated by the example. When I explain the attributes to someone, they all say that's a terrible investment, yet they still own the bonds. So how do I justify it? I have no interest in owning bonds. But I'm going to argue the other side real quick, because I've had a few advisors actually put up a credible argument and say, all right, well, if I don't do bonds, what do I do? If I go all in on stocks, it's a lawsuit waiting to happen, because, I mean, if the stock market goes down, everyone's going to look back and say, well, obviously it was overvalued and obviously it was volatile. And you can't do that. They can't go all in on stocks. So REITs, convertible arbitrage, market neutral, all these things are positively correlated with stocks when the stock market's going down. They might be uncorrelated on the way up, but I mean, everyone's seen with their own eyes that most of these alternative investments all of a sudden magically become highly correlated with stocks when stocks are going down. So they don't want to do that, and they don't like the fees, they don't like the taxes, and they don't like the homework and having to explain these alternative investments. So they feel like they have nowhere to go. So they say, Eric, essentially what you're telling me is go to cash, right? That bonds are a bad bet. I'm not doing any of these alternatives anymore. This is what they tell me. So you're telling me to go to cash. Well, cash is just bonds with no yield. It's the same thing. You're still suffering the inflation drag. So I'm right back to bonds saying, well, at least get some yield rather than no yield. And I didn't really have a good answer to that other than, well, you have to find an alternative investment that you actually believe in. If you don't believe in REITs and you don't believe in all the other ones, the list, of potential alternatives actually narrows down to the one that I actually believe in. So let's have a conversation about that. So to answer your question, I'm not willing to have a dedicated long position in bonds right now because the attributes are I expect to have a negative real rate of return. Most people don't know that corporate bonds and government bonds in the U.S. had a negative real rate of return from 1940 to 1983. Negative. The nominal return was positive. It was a small number, but the real return was negative for 43 years. I don't think people are aware of that. So that can happen again, and it's a good chance that is what will happen again. So I don't have any interest in owning bonds, but I can understand why other people do if they feel trapped.
Yeah, I think your argument about having to find a suitable replacement is a good one. Morgan Housel's had one of the best arguments for individual investors holding bonds I've heard, which is basically it prevents you from selling your stocks. So effectively, if you have that risk, limiting factor in your portfolio, when stocks go down a lot, you're less likely to sell your stocks. And if your stocks are going to generate a lot of your return over time, then that behavioral component, tends to help you. But so I guess your point is true. You need some sort of replacement for that if you're not going to own bonds.
Yeah, and my rebuttal to that, and I agree, it's generally true. It's easy to feel that way looking back over the last 40 years, but what do you do when stocks and bonds go down together like they did several times in the 70s? If you're expecting treasuries to go up when stocks go down, you're already seeing the correlation start to creep up and become positive. What do you do then?
Yeah, you don't have many options. I wanted to ask you, there was one other thing on your list of potential investments you consider or different markets you consider that I thought was interesting because I didn't even know how you potentially could invest in this. And that was carbon emissions credits. And so I was just wondering if you could talk a little bit about how that works, how you can invest in carbon emissions credits.
Yeah, so I'm not an expert on investing in them directly. I trade the futures contracts on carbon emission credits, and it's one of the most liquid futures markets in the world, and it has been for a decade now. And most people are still unaware of it. It trades over in Paris. It's a fully regulated CFTC approved futures contract, and it's a big part of our program. It's also been one of the best trending vehicles for a decade now. My understanding of carbon emission credits is it's a European Union thing where in an attempt to control pollution and carbon release into the atmosphere, the government, issues these credits to different corporations, and they allow you to pollute up to a certain amount. If you want to pollute more than that amount, you need to go buy those credits from someone else. So it incentivizes people to curtail their own pollution and then turn around and sell those valuable credits to somebody who doesn't want to spend the money to alter their factories or whatnot. It's an interesting system. I don't know if it's making a big difference, but I can tell you that it's a very liquid futures market, and I'm very appreciative to have it in the portfolio.
Interesting. Yeah, I didn't know much about that.
The other thing I would add, let me add one more thing. I'm constantly getting beat up by the crypto guys for not having crypto or Bitcoin or Ethereum in my portfolio, and they're always talking about all the returns they missed out on, blah blah blah. What they don't realize is that crypto liquidity in the futures world is actually pretty small. It's the 79th most liquid futures market in the world, which puts it down there with like feeder cattle and palladium and Japanese platinum. Relatively illiquid markets that don't move the needle very much. But it's true. It went from 10,000 to 40 or 50 or whatever it did. But carbon emission credits are a deeply liquid market that went up a lot more. than crypto did over that same period of time. I think it's gone from 5 to 45 or 9x or something like that. So, and then I turn around and ask them, are you trading carbon emission credits? And the answer is, what's that? So, there's trends out there that no one are even paying attention to that can be monetized.
Yeah, it's interesting. If you ask people, what's more liquid, carbon emissions credits or Bitcoin, they would tell you clearly, crypto is more liquid. But, the reality is the opposite of that. So that's interesting. Just one last question I want to ask on this section is I want to ask you about how you think about, so we talked about some of the assets that go into an all-weather portfolio. The other big component of it is how do you weight those assets and, considering risk and return and, all of that. I'm just wondering if at a high level, if you can talk about how you think about how you do, how you manage the weights between all the assets in an all-weather portfolio.
Right. So here's an area where I'm going to have a different answer, and I need to admit that I've changed my thinking on this. I spent the first probably 20 years of my career putting a really strong emphasis on the aspects of portfolio construction that allow you to maximize the perceived diversification benefit. So essentially identifying low correlation, low covariance portions of the portfolio and thinking those need to be weighted higher. And then finding redundant, highly correlated portions of the portfolio and feeling like those need to be reduced. Because in theory, that's beautiful. And on paper in a spreadsheet, it's amazing. It's amazing. But like so many things in life, real life, the real experience shows that the theory's incomplete. So, and you can only learn this either vicariously through the experiences of others, which I try to do, or painfully with your own money on your own time. And what I've found is that the tendency to trend and the tendency to deliver thick, healthy risk premiums corresponds pretty strongly with rising correlations and rising volatility. So now, that doesn't mean go crazy and go out and overweight everything that's highly redundant and correlated, but respect the fact that when you do an honest assessment of your historical profits, if you shied away from things that were rising in volatility and correlation, you're shying away from future profits. And if you dilute them and take those risk units and deploy them into things that have lower volatility and lower correlation, you end up overweighting things that aren't trending and are having whipsaw conditions, kind of sideways markets. And so you need to strike a balance. On one hand, you need to regulate the portfolio risk, but you don't want to do it so much that you're giving more than you get out of that behavior. Does that make sense?
Yeah, absolutely.
Okay. So to answer your question, I think the question you ask is how do you weight? So it goes back to what I said earlier, where it's liquidity. I weight the portfolio based upon the liquidity. I have some guardrails, some common sense guardrails. Something could become so liquid that it dominates the portfolio. So there are caps in there. But generally speaking, I just let the liquidity and the markets and the trends tell me where I need to allocate. And once that portfolio is set, then I have a set of rules that decide, well, how much risk do we want to take on that portfolio? What I don't do is go in and chop the portfolio up into pieces and say, hey, this market is a good diversifier relative to the rest of them, so let's steal from them, rob Peter to pay Paul. I used to do that, and that's okay, but you're taking some model risk and you're essentially embedding a set of rules that take from trends and give to non-trending markets, and that's not what I want to do. So I don't know if that's a good answer, but it's an honest answer.
Yeah, I think that's unique. I think, from if an individual investor is trying to think about this concept of an all-weather portfolio, I mean, the most simplest might be just, 4 or 5 asset classes and equal weight and then rebalance on an annual basis, something like that. But that your process is very different. And like you said, it's based on this liquidity sort of factor.
You could think of it as market cap weighting across all asset classes if in futures you look at open interest as market cap. Yeah, and there is rebalancing. It's just the market tells me. If the hedgers are leaving the grains complex, they're getting out of soybeans, they're getting out of corn, they're getting out of soybean oil and canola, that'll show up in lower open interest, and my position sizes will naturally and organically decline in that space. And if open interest is increasing in nickel, tin, and zinc and copper, then my position sizes over there will increase proportionally to that. So there is a granular, slow rebalancing that just kind of follows the liquidity and goes to where I believe the hedging demand or the risk premia is.
On your website, you had a white paper, and we'll link to this in the podcast, but it's multi-asset blend, and you're basically showing the historical drawdowns of a multi-asset blend strategy versus sort of global equities or the stock market and stocks. So I just was wondering, can you just talk to what some of your research has shown in terms of the risk and return profile of the type of strategy we're talking about versus something like the broader market, or even something like the 60-40, with the caveat that we know the last 40 years, like we've talked about, have been obviously great for both bonds and stocks. But when we look at what you might expect out of a strategy like this, like how would it look, react, and behave over time and in different market environments?
So is what you're referring to on the website, does that go back to the year 2000?
Yes.
Right.
Yep.
Right. So
I don't know if that's the same strategy or slightly different, so I apologize if we're sort of blending here.
no, it's okay. That's essentially, we view that as kind of a benchmark. So we're using the SG Trend Index, which is an index of trend following firms that are charging 2 and 20. So it's net of their fees, kind of index of big trend following hedge funds, which we view as kind of our peer group. And then we're blending that in with a market cap weighted global equity index. I believe it's the MSCI World Index. And it's real simple. I think it's a 50-50 blend rebalanced annually. So, and that's just to give people, it's to demonstrate the impact of marrying trend following to global equities and just seeing what that would have looked like, over the last 20 years or so. I wish that index went back into the 70s. So my own internal research, I go back into the 60s because the 60s, the 70s, the 80s, I think are more indicative of the future than the 90s and 2000s were. So it's important to get all the seasons in there. If you want to run an all-weather portfolio, you need to know how it did in all the seasons. And almost nobody else in the world is looking at the bad season, which was the 1970s. So to answer your question, maybe a little background. So I'm a data guy. I'm a database guy. So I went to school. I studied finance, but I studied computational finance and computer science, and databases were my thing. And collecting data, cleaning data, reconstructing history as it actually happened, rather than just the convenient, what's left over after everything else has been expunged. So I'm talking about survivorship bias, understanding these things. So I'm qualified to go back and recreate history as it actually unfolded, and that's important because if you don't do that, you get this idealized version that doesn't show you all the failure. Like you don't know. Like if you go try to pull up a chart of Enron, it'll say error, and no such thing as Enron. But I was trading Enron. I know it was there, right? Lehman gone, pork bellies gone, Deutschmark gone. You have to go back and painstakingly create an accurate version of history, and with each passing day, the meme or the idealized notion of what history was gets more and more corrupted. So, doing it correctly, and then analyzing all the different funds that have ever existed, all the hedge funds, the mutual funds, the UCITS, the SMAs, the insurance products, this massive database. It's real easy to run a query and say, what would have helped? What could I have invested into that actually would have helped a stock and bond portfolio from, say, 1968 to current? And it's kind of a slap in the face when you realize that 98% of all investable products that have been created are highly correlated with the stock market when it goes down, except for fixed income vehicles. But those are highly correlated with the aggregate bond index or the 10-year treasury when it goes down. So it's no wonder that everyone just really sees these two pistons, stocks, bonds. But there is one asset class that historically has been very consistent at producing positive returns when in really hostile stock market environments. And it's been consistent at producing positive returns in hostile bond environments. But most importantly, it's been consistent at producing positive returns when both stocks and bonds go down. And it's this thing called managed futures, systematic global macro, trend following, whatever you want to call it. And I first noticed this, back in the late 90s, and I thought, why does no one do this? It's the only thing that really stands up and delivers when you need it the most historically. So I don't know if that's a good answer, but that's how I have confidence in this strategy, because you can look at the weight of the evidence and see that nothing else actually moves the needle. Some people argue for gold. There are times when gold helped a lot. There are other times when it was the worst thing you could have picked. Same thing with, real estate used to be a decent hedge against inflation. Not so much anymore with the globalization and the financialization of assets is increased correlations to the point where the only thing I'm comfortable with is a relatively aggressive, plain vanilla trend following approach applied to a broad, universe of futures contracts. And I don't expect it to work every single time, but it's the best bet. And so all the empirical data backs that up, and my experience backs it up. So that's why I do it.
I wanted to ask you about this concept of risk parity. We had Adam Butler on the podcast, which I know you know Adam and the guys at Resolve, and we talked to him about risk parity. But what do you think about the concept of risk parity, and how do risk parity portfolios, I guess, differ from your style of investing?
So can you elaborate? What do you mean when you say risk parity?
Jack, do you want to help me out with this one?
Yeah, it's essentially, for me, risk parity is, weighting asset classes based on the risk, they contribute to the portfolio. I think a lot of people tend to think risk parity is stocks and bonds, but risk parity is actually a lot more than that. But yeah, I think the big concept is, looking at them relative to the risk they contribute to the portfolio.
So what you're describing is an equal risk contribution portfolio of stocks, bonds, probably gold, maybe some commodities, and maybe something else.
Yeah, maybe. I guess it depends on who's implementing it.
So on paper and in theory, I love it. I love the concept of equal risk contribution. How could you not? Because you don't know what's going to happen in the future. So why would you just choose one asset class and say that's the one, I want to bet it all on that, rather than have 4 or 5 things working together as a team? Hopefully they're uncorrelated and not redundant with one another, and just do the prudent thing and make sure that they have relatively equal risk contribution. How could you not love it? Again, it's in theory and on paper and on a spreadsheet. I love it. In practice, it gets more complicated. Back to the discussion we were having about bonds. How do you justify having a leveraged bond position right now? I don't know how to do that. Do you?
Yeah, no, that certainly is challenging given what the outlook is for bonds. Right.
So, but if you take it out, it has an effect on all the other asset classes. Like the whole thing changes if you take out the bonds. The other one is, gold. Is gold still gold? Is Bitcoin gold? I remember when gold went down for 20 years, after the 80s, and I got fired from a job for having gold in the portfolio, in the year 2000, which was the exact bottom in gold. So in practice, there are some challenges to running risk parity portfolio. It does make a lot of sense to me, though. I chose not to do it because I think there are smart people out there that are going to do a better job than I can at that, and the world doesn't need me to run a risk parity portfolio. But the challenge for me was the bond thing, the potential for one asset class to just be out of favor for 20 years, and then the long only nature of it, meaning like I am not a believer in being long only commodities. Commodity prices might be higher than they were 20 years ago and 40 years ago. That doesn't mean your total return from being long commodities is positive, though. You got to pay the storage cost, the transport cost, the insurance. The cost to carry, by my calculations, is higher than the nominal return in the price of the commodity itself. So I don't view long-only commodities as a legitimate source of return. So therefore, because of this, I end up with this trend-following approach. So hopefully that makes sense.
Why do you think trend following works? What's effectiveness behind it?
So here's where I'll be very controversial. I have super strong opinions on this topic, and I've dedicated a healthy portion of my life to analyzing this endless circular reference on why trend following works. Maybe the best way is to share with you a story about my college years. I went to Wichita State University in Wichita, Kansas, which is, kind of that's an agricultural part of the world. There's a lot of aircraft manufacturing and a lot of farming and a lot of commodity trading. The Koch Industries is there, KOCH, and I think they trade 21% of all the commodities volume in the world on it, some crazy number like that. And I don't know if you guys have ever been to Wichita, Kansas. It is literally the most boring place on the planet to live. It's flat, it's windy, it's scorching hot in the summer, it's freezing cold in the winter, and there's absolutely nothing to do. So, but still, there's a lot of money there. There was Cargill and Koch Industries and Boeing and Raytheon and Cessna. So there's just lots and lots of industrial and agricultural stuff going on. So there's talent there. And I went to the university there and I started a club for finance, like computational finance, people that wanted to kind of merge computer science and finance together. And this was in the mid 90s. So it was before, there was something called quant or computational finance or AI or machine learning or any of that stuff. So over time, this little club attracted people that worked on hedging desks at Cargill and Koch Industries and financial engineering types and people doing systematic things, but mostly on the commercial side, on the hedging side. They weren't speculators. They weren't trying to trade to make a profit. So I had the unique experience of interacting with these people and comparing notes and, comparing computer code. And, this was before Python. This was before the convenient stuff. I mean, we were using Fortran and C and crappy computer languages like that. It was hard and cryptic. But I learned something, and it took me a while. I'm kind of dense and stubborn, but I just couldn't figure out why these guys are so happy about losing money, because I would look at what they're doing and I'm like, yeah, but your annualized return is like negative 2.1%. And these guys, a lot of these guys were from Russia, Belarus. These were all PhDs in like computer engineering and whatnot. And they're working, on the code at major companies to build hedging programs. And then one day, after just constantly asking them, why are you trying to lose money? And they said, well, they showed me they didn't show it to me, but they explained to me how their compensation worked. And I'm like, wait a minute. You're not trying to make money. You're actually trying to hedge some risk on the balance sheet or the income statement of the company you work for. You're not profit seeking. So it's my fault for not recognizing that anyway, since both of my grandfathers were wheat farmers and hog farmers who hedged. I realized these guys are deep and they have huge amounts of money to put to work, and they're not profit seeking. Like, why do you want to sell markets that are up and buy markets that are down? As they're simply hedging. Sometimes they're hedging input costs by buying markets that are going down, and sometimes they're hedging, their output prices by selling markets that are going up. And I didn't realize it at the time, but much later on, I realized that I think this is my theory, is that that's the source of the profit for trend followers. Because we're the only people that are consistently willing to stand up and provide them liquidity in their moment of need. I mean, they desperately want to sell rising markets, and they desperately want to buy falling markets. And they're not trying to make money in the futures markets. They're trying to create negative correlation to some terrible risk on their balance sheet. So and if you remember what we talked about earlier, where I said, you have to contribute something valuable, provide some valuable service to the marketplace in order to stay there and compound. I believe trend followers unknowingly provide this situational valuable liquidity to commercial hedgers, for which the markets were actually invented, for commercial hedgers, not for traders, not for speculators. And trend followers don't even realize that's the source of their profits. So if you realize that, it makes life a lot easier, because this is the only industry that I've ever come across where people can build a business and not even understand why they do, or why what they do works. And I can't live that way. So I'm constantly trying to refine that theory and have someone, prove me wrong. And no one has yet.
It's always good to be on the other side of somebody who doesn't have a profit motive, I guess, for your own long-term returns.
Yeah, I've had people ask me, well, why do you want to trade against people that have more market knowledge than you? And I say, well, because they're essentially buying insurance. That's how they view it. So in what world would it make sense that the purchaser of insurance would get paid to insure themselves, and that the writer, the person, underwriting the risk on the other side, would pay them for the the luxury of taking risk from their balance sheet to mine, which is valuable to them. It's not valuable to me. Why would I do that at a loss? It doesn't make any economic sense. So yes, it is a comforting thing to understand. And I can't prove it. It's not provable because it's all circumstantial and the markets are anonymous, but still it's helpful.
We run some long-term trend strategies ourselves on equities. And, one of the things that happened this year, obviously, is these types of long-term trend strategies struggled a lot because we had such a massive quick decline, then we had a quick bounce back. And there's this whole concept out there that the market is sped up and maybe these long-term trend strategies need to be altered now because we're in a different type of environment than we were in the past. And I'm just wondering what you think about that. I mean, do you think the current market environment or anything that's happening going forward would dictate maybe changing the way trend following is implemented, or do you think this is maybe more of a short-term thing and we need to focus more on what's worked over the long term?
I think a better approach is to simply diversify across different speeds to smooth that out because you don't know what's going to work the best going forward. So for example, I diversify across 6-month, 9-month, and 12-month breakouts because I don't know which one's going to work. Now, the 9-month breakout is historically been much more profitable than the 6 or the 12 until about a year ago. And the 6 is just lights out more profitable than the 9-month or the 12-month. But I didn't know that in advance. So by diversifying, and you don't have to stop there. You can do 4 months, you can do 14 months, 16. You can't go all the way out to 5 years and you can't go down to 2 weeks. But there's a nice zone where you can diversify across all of them. I agree that markets feel like they've sped up. I mean, heck, it feels like we've gone through like 4 full market cycles since the beginning of 2020. And there is a feature of markets that are maturing as they get mushier. They get more skew risk, lower signal to noise ratio, which to the human mind feels like things have sped up. But I would also caution you and say, like in the 1970s, we had some speed then too with stocks. I mean, I've run stock trend following programs in the 1970s, and that felt a lot like COVID a couple times. So it's not like we haven't seen it before. So for me, I wouldn't go making wholesale changes across the whole system. I would just diversify and make sure I have some short term, some medium term, and some long term, and be happy with the weighted average of those going forward.
That makes sense. We're value investors, so we obviously are very familiar with struggles over the past decade. But trend and a lot of other factors also have had a tough time, coming off on the backside of the financial crisis. And I'm wondering just how you look at that period and put it in context. I mean, do you think anything has changed with trend following where maybe it won't work as well in the future as it has in the past? Or do you think this is just a period like any other factor where you have these long periods where they don't work and you've got to stay the course through them in order to, have success with them?
There's no good satisfying, intellectually honest answer to that. I'll share with you, I think, 3 observations that I made. One, if you just take the trend following returns, you say going back to 1970, and you scramble them, and you plot them, and you scramble them again, and then plot them, and you do this, a couple thousand times, you're going to see plenty of 10-year stretches where it felt like the last 10 years. You're going to see it. So it could just be spurious nonsense where you can't make money every decade. You're going to have a lost decade just like every other asset class has. It could be that. Not sure. The other thing I would point out is, and a lot of people don't realize this, is that when you invest in a managed futures manager or a CTA, and let's say you guys give me $1 million and say, Eric, run this futures program for me. I only need about 100,000 of that to post the margin for the futures contracts. The rest just goes into T-bills. That's what CTAs, they just stick it in T-bills, right? The 50-year average annualized return for T-bills is 4.7%. That's the 50-year average. But over the last 10 years, it's been closer to 0, right? So if you take a fund or a program that's had, let's say a 10% or let's just say 12% annualized return for a long time, and you steal 5 out of that, right? And then you cherry pick a bad start date, and then you cherry pick a bad end date. Guess what? You're going to get a lost decade, right? So a lot of those returns just vaporized that. So if you remove the collateral yield component and say, just show me the trading result returns, and go back to 1970 and just show me those. And if you do it for the old school plain vanilla trend following approaches, I don't see any deterioration. So, I mean, you could make a case that it's slowed down a little bit, but nothing meaningful enough for me to say, aha, things aren't working as well. So the underlying core premise, of trend following, to me, hasn't deteriorated for the old school, simple trend following approaches. I think so. That's two things. The third one is, in this industry, there's so much pressure to differentiate, and there's so much pressure to justify the 2 and 20 fee structure that I think people spend way too much time on artificial intelligence and machine learning looking for risk premia that doesn't exist. I mean, it's not alchemy. You can't create risk premia out of thin air. And what this does is, if you just keep running all these genetic algorithms and machine learning and AI, which I went to school for twice, you're not going to find anything that other people haven't found. There's just the structural risk premia have been known. You can go read papers from Holbrook Working back in the 1940s. He explains it all. That's the structural risk premium, and it hasn't changed, and it's not going to change in the future. So the rest of this stuff is really just, running in circles, chasing your tail, in my opinion, justifying fees. But what it does do is it creates model risk, and it'll tilt you towards whatever has been working recently. And you saw a lot of during COVID, about half the CTAs did terrible. I mean, atrociously bad. Some of them were down more than the market. Trend following CTAs. The other half did fantastically well. All right. Why? What is it? What's the difference? Well, the other half stuck with old school trend following approaches because those things worked during COVID. The half that struggled, they're real quiet now, but at the time, if you read their marketing materials going, pre-COVID, it was all about that, we're moving away from trend following. It doesn't make a lot of sense. It's not working as well as it used to. We've got all this advanced artificial intelligence and machine learning and whatnot. And I think that biased them towards more stock market beta, because that's the only way you could have juiced the returns in the 5 years leading up to it, which explains why they had a 99% correlation with the stock market, for the year before that and the year after it. So, and I can't prove it, but that's my suspicion. So, sorry, I may have gone off on a tangent there. Did I answer your question?
Yeah, no, that was great. You definitely answered it.
Just two more questions before we wrap up. I wanted to ask you about sort of investor behavior. We've had Jim O'Shaughnessy on the podcast, and he kind of talks about how there's two failure points for an investor. One is an asset can go down and they can sell at or near the bottom and capitulate. So that's one failure point. The other failure point is an asset or a strategy can deviate a lot from the market. And, they might capitulate when they're not getting the returns, let's say that maybe the stock market is, or some other investment strategy. So it seems like that second failure point might be a little bit more of an issue with something like an all-weather approach. But can you just talk about how you kind of think about that and manage that type of, and try to protect your investors and the people following your strategy from that second failure point and sort of giving up at the wrong time?
O'Shaughnessy is a really smart guy. There's a lot of wisdom tied up in that man's head and at that firm. So I commend you for paying attention. I completely agree. Those are the two things that create the inflection point where the emotional pain or trauma or whatever reaches that apex moment where they, empowered to make a decision. And that's usually to do the wrong thing at the wrong time. So we're not talking. So if you run a diversified approach, whether it's all weather, risk parity, anything that's increasing the diversification, you've moved in the direction of solving the first problem. In that you've now have a much greater chance of not putting people into a position where they're down 40 for the year, or 50 or 60 or 30 or whatever. So you've done what you can to solve that problem and maintain something that long-term is expected to have a rate of return that's competitive with the stock market or 60-40 portfolio. What you're driving at is the second point, which is because people are benchmarking you to the S&P 500 or the NASDAQ on an hourly basis every hour of their life, how do you deal with the situation when, the S&P is up 20 for the year and you're up 11 and they're really upset? So nobody has a great answer to that. The formula that I use is simply being brutally honest with people up front that that's the cost of investing this way. So I can show you the 50-year kind of window of what just investing in stocks look like. And yeah, it looks great, but let's zoom in on the wiggles, and you can see, if you had $1 million and now you have 500 grand, how are you going to feel? So on and so forth. And they're like, wow, okay, yeah, I get that. That's a little too hot for me. Then you can show them 60-40 and they say, well, that I can deal with that. It makes less money, but it's much more palatable. And then you talk to them about the current bond conundrum and they're like, well, we don't want to do that. That's crazy. So when you show them all weather, and I've done this via experiment, where I have anonymized asset classes and I show people all weather, I show them stocks, I show them a balanced portfolio, I show them managed futures on a standalone basis, and I let them pick, but they don't know what they're picking. It's just color coded, anonymous, and 99 out of 100 people choose all weather, and 0% of people choose stocks. 0. And when I force them to eliminate an asset class and say, you got to pick one to get rid of and you'll never invest into it again, almost everyone picks the stock market because they don't know what it is. All they know is it's got huge drawdowns. So, and then when you reveal to them what they picked, they're shocked. They're like, what do you mean I picked something that had managed futures in it and I didn't pick stocks? So they have to buy into the long-term plan. And it's not that hard to show them that, yeah, there's going to be times where over an 18-month window, the stock market's straight up and all weather is just doing its all-weather thing. It just keeps on plodding along, right? And if that's going to drive you crazy, then don't do this. But go into it with your eyes wide open, understand what it is you're giving up. Then you empower people to make a risk-reward decision, right? If you don't do that up front, then they have to do it in real time. And in real time, all they know is their friends are bragging at the country club and they're up 20% and we're only up 9 or 10. And I feel like I'm getting ripped off or I'm missing something and I just don't like it anymore. So their emotions conspire against them and now you got a problem. So it's not a perfect solution, but if you're just brutally honest up front and you set expectations correctly and you isolate the trade-off, like this is what you're giving up, is that you're going to underperform for 12 to 18 month stretches at times, and they can visualize it and look at the magnitude and the duration, and essentially they sign a contract in their mind of saying, yeah, that's acceptable to me for this low volatility long-term thing that I'm getting in return. At least now I know why I'm doing it. So hopefully that makes sense to you guys.
Yeah, I love that. Be, brutally honest, educate these investors. I love the idea of removing those labels and then just placing the equity curves in front of them and the statistics. And then, they chose the strategy that you would want them to choose, but if maybe you said, would you rather invest in the S&P 500 or all weather? Immediately they're going to say maybe the S&P 500, just given what they know. So I think that's really, that's a really interesting tactic for sure. So just to wrap up, I wanted to ask you about this paper you wrote where you showed that a very small percentage of stocks drove a lot of the market's return over time. And I think, one, way that people talk about index investing is just invest in the index. You're going to get exposure to those stocks. Don't really worry about trying to pick those stocks because a market cap weighted index is going to have those best performers in there. But I think you looked at another sort of approach to this using trend following. So I just wanted to sort of hear your thoughts on the research around a small number of stocks generating a lot of the returns, and then what you basically uncovered in that research in that paper. Yeah,
so I've written 3 papers when I was with the previous firm. The first one I believe was in 2006, and then another one in 2009. Another one I think it was 2013. So I'm not sure which one you're referring to, but the concept is kind of the same throughout all the papers. It's true that a very small minority of stocks are responsible for essentially all of the market's gains. That has been true, and it was true in the US, it was true in Canada, it was true in the UK. So now you can't see this unless you painstakingly go back and reconstruct history as it actually unfolded. You have to include all the delisted stocks. You got to handle all the dividends, mergers, divestitures, all the corporate actions, and you need to do that correctly. And that's expensive and time consuming to do. But I'm a weirdo. That's my passion. So that's what I did. And it was fascinating to see that, more than 100% of the market's gains came from I think it was the 20% strongest stocks over the course of their lifetime, which meant collectively the rest of the stocks collectively had a negative lifetime compounded return, which was fascinating at first until I thought it through and realized that, well, with a limited liability, which wasn't always there. Once you implemented that, then you're going to get a different payoff structure, and it's going to be a winner. It's going to create, or it's going to incentivize a winner take all system where there's, 2/3 of the stocks actually have to underperform. So it basically creates a different distribution. And there were two arguments, like you correctly articulated. One is, well, you could implement a trend following approach to try to capitalize on this phenomenon by putting yourself in a position to overweight or more strongly participate in that small minority of stocks, because clearly they have to keep hitting new all-time highs in order to do this. And then with your stop loss, you could avoid the other stocks. So I did that for a living for a long time, and it worked. It worked just as I expected it to. It was pretty good. A lot of people told me, well, that's the greatest. And in fact, most people, I would say 8 out of 10 people, took one of those papers and they used it as a justification for indexation. And at first I was scratching my head and I'm like, I was trying to make the case against indexation. But then after talking with a few of them, I realized that what they're saying is, well, look at the weightings in the index, right? It's slower, but a market cap weighted index is a trend following system. It's just a really dumb one. With no risk management. But if a stock goes up in value, they buy more of it. If a stock goes down in value, it gets a smaller weighting. If it goes down enough, it gets kicked out of the index. That's a slow-moving, brute force trend-following system just without any risk management. So there are two things I'd like to share with you. One was when you adjust for taxable money, and you adjust for transaction costs and turnover and the operational workload and cost associated with running a trend following program around it, you realize that a lot of that alpha disappears. Not all of it, but a big chunk of it, and that's just real life. And then because you go to cash in hostile market environments and you don't have a lot of exposure, you're going to miss the rebounds. You always miss the rebounds. And you guys talked about this earlier, and it's painful to miss the rebounds. And the way you make up for that is by using a modest amount of leverage at the portfolio level to get the compounded return back up. Because you got rid of the left skew, but you gave up something for that. But now that you've got rid of a lot of the left skew, you can use a gentle amount of leverage to lift it back up. And that's great in a hedge fund format. It's great in a managed account format. Not so great when you're delivering it to retail investors in a mutual fund or an ETF format. Leverage is a minefield. So, did it work? Yeah. Did it work better than market cap weighted indexation? It depends on your definition of better. So you guys might be wondering why I use market cap weighted indexes and not trend following on stocks in my own all weather program. And it's because that trend following on futures, which I love and I do, shares the same blind spot as trend following on stocks. They tend to kind of wash out at the same time and be under allocated at the same time. They're correlated, because they're doing kind of the same thing in different asset classes, but they're cousins. They're not first cousins. They're kind of like second or third cousins. But market cap weighted index is very different than trend following on futures. Negatively correlated, different families, different DNA, different genetics, completely different, and they blend together beautifully. So that was kind of a surprise to me. And it was a tough decision for me. Well, it was a simple decision, but psychologically it was tough to give up on the trend following on stocks. I felt like I put so much into that, right? So the other thing I would point out, I said there were two things, was that paper, which I got a lot of credit for, my previous firm got a lot of credit for, I felt was nowhere near as important as another paper I wrote that not a single person in the world read or ever talked about. It was called The Non-Random Behavior of Declining Stock Prices. Which to this day, not a single person has reached out to me. But essentially what I did is I measured the annual calendar year returns for every stock that was in, I think, the Russell 3000 from 1989 to 2008. And I plotted it into a distribution. And it was this beautifully perfect log normal distribution, just like what they taught me at business school, except for one data point was completely way off. Everything else was spot on. You couldn't tell the difference, but there was one data point where real life couldn't be more different than what you get taught in business school, and that was the left tail. It was the left tail. It was a number of stocks that were down more than 70% for the year. It was a huge left tail in real life, no left tail in any of the academic literature. So that tells you what the difference between real life and what you're taught in business school and the assumptions that go into all these models. And that's powerful and valuable information.
This has been a really interesting, valuable. I've learned a ton, and I've still got a lot more to learn. I think. But where can investors go to learn more about you, your firm, your research, the strategies you run?
Yeah, our website, standpointfunds.com, is a great place. We've got a lot of good stuff on there that I think is worth taking a look at.
And it's a relatively, I mean, you've been in the money management space for, almost, I don't know, maybe 20, 25 years at this point, but Standpoint's a relatively new firm that you have sort of found, correct?
Yeah. So me and 4 other partners founded Standpoint in August of 2019. So we are a relatively new firm, but we're some really old souls that work there. Really old. So you see this gray hair, guys?
Yeah.
Like, I shouldn't be this gray.
I see the gray beard.
Yeah.
But anyways, well, listen, Eric, thank you very much for joining us. We really appreciate it, and we hope you have a good weekend.
Awesome. Hey, thanks, guys. I appreciate it, and I look forward to the next conversation.
Thank you.
Take care, guys. Bye.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.